Technical analysis offers a valuable window into market sentiment and price movements. Among the many tools available to traders, candlestick patterns stand out as powerful indicators of potential trend reversals and continuations. These patterns, with their origins in ancient Japanese rice trading, provide visual representations of price action, making it easier to identify trading opportunities. One such pattern that has gained popularity among traders is the Tasuki Gap. This intriguing pattern, characterized by its unique gap and subsequent price action, can offer valuable insights into the balance between bullish and bearish forces in the market. Understanding the nuances of the Tasuki Gap pattern can be instrumental in making informed trading decisions. Whether you are a seasoned trader or just starting, familiarizing yourself with this pattern can significantly enhance your trading arsenal. In the following sections, we will delve deeper into the intricacies of the Tasuki Gap, exploring its bullish and bearish variations, and providing practical tips for its effective application in your trading strategies. The term Tasuki originates from the Japanese word for a sash worn around the waist, often used to tuck up sleeves while working. Imagine a garment slightly loosening and then tightening again. This visual analogy aptly describes the price action observed in a Tasuki Gap pattern. In essence, a Tasuki Gap pattern emerges when a price gap is followed by a candlestick that fills a portion of the gap, but then closes back within the gap, resembling a sash being tightened. This distinctive price action signals a potential shift in momentum and can foreshadow either a bullish or bearish reversal, depending on the context of the preceding trend. The beauty of the Tasuki Gap pattern lies in its simplicity and reliability. It's like a beacon in the often chaotic world of financial markets, providing clarity and actionable insights for traders. By mastering the art of identifying and interpreting this pattern, you can gain a significant edge in your trading endeavors. However, like any other technical analysis tool, it's crucial to remember that no pattern works in isolation. Combining the Tasuki Gap with other indicators and a thorough understanding of market context is key to making well-informed trading decisions. The bullish Tasuki Gap pattern typically emerges after a period of downward price movement, signaling a potential reversal to the upside. Picture a market where bearish sentiment has prevailed, pushing prices lower. Suddenly, a gap down occurs, often fueled by negative news or a bearish earnings report. However, instead of continuing its downward trajectory, the price action takes an interesting turn. The next candlestick opens within the gap but then rallies, closing above the midpoint of the previous candlestick, effectively filling a portion of the gap. This price action indicates that the selling pressure might be waning as buyers step in, eager to capitalize on what they perceive as an oversold market. The bullish candlesticks close above the midpoint of the previous candlestick further reinforces the bullish sentiment, suggesting that the bulls are gaining control. Section 4. Practical application. Bullish Tasuki Gap in action. Let's consider a practical example to illustrate the application of the bullish Tasuki Gap pattern. Imagine you are monitoring the stock of a technology company that has been experiencing a steady decline in price. The stock gaps down significantly at the open, seemingly confirming the bearish sentiment. However, as the trading day progresses, you notice that the stock rallies strongly, forming a bullish candlestick that closes above the midpoint of the previous candlestick. This price action catches your attention as it resembles the characteristics of a bullish Tasuki Gap. Intrigued, you delve deeper into your analysis, incorporating other indicators to confirm your observation. You notice that the Relative Strength Index, or RSI, a momentum oscillator, is showing signs of divergence, indicating that the selling pressure might be weakening. Furthermore, you observe that the stock is finding support near its 200-day moving average, a widely followed technical indicator. Armed with this confluence of bullish signals, you decide to initiate a long position, anticipating a potential trend reversal. Section 5. Decoding the bearish Tasuki Gap. In contrast to its bullish counterpart, the bearish Tasuki Gap pattern emerges after a period of upward price movement, signaling a potential reversal to the downside. Imagine a market where bullish sentiment has been driving prices higher. Suddenly a gap up occurs, often fueled by positive news or a bullish earnings report. However, instead of continuing its upward trajectory, the price action takes a bearish turn. The next candlestick opens within the gap, but then sells off, closing below the midpoint of the previous candlestick, effectively filling a portion of the gap. This price action indicates that the buying pressure might be waning as sellers step in, eager to lock in profits or initiate short positions. The bearish candlesticks close below the midpoint of the previous candlestick further reinforces the bearish sentiment, suggesting that the bears are gaining control. Section 6. Practical application, bearish Tasuki Gap in action. Let's consider a practical example to illustrate the application of the bearish Tasuki Gap pattern. Imagine you are monitoring the stock of a retail company that has been experiencing a surge in price following strong earnings results. The stock gaps up significantly at the open, seemingly confirming the bullish sentiment. However, as the trading day progresses, you notice that the stock sells off sharply, forming a bearish candlestick that closes below the midpoint of the previous candlestick. This price action catches your attention as it resembles the characteristics of a bearish Tasuki Gap. Intrigued, you delve deeper into your analysis, incorporating other indicators to confirm your observation. You notice that the on-balance volume, or OBV, a volume-based indicator, is showing signs of divergence, indicating that the buying pressure might be weakening. Furthermore, you observe that the stock is encountering resistance near its upper Bollinger Band, a volatility indicator. Armed with this confluence of bearish signals, you decide to initiate a short position, anticipating a potential trend reversal.